supply and demand dislocations are bringing it down. The motor vehicle sector provides a good illustration. Earlier in the pandemic, demand for vehicles rose sharply, supported by low interest rates, fiscal transfers, curtailed spending on in-person services, and shifts in preference away from using
Wow.
public transportation and from living in cities. But because of a shortage of semiconductors, vehicle supply actually fell. Vehicle prices spiked, and a large pool of pent-up demand emerged. As the pandemic and its effects have waned, production and inventories have grown and supply has improved. At the same time, higher interest rates have weighed on demand. Interest rates on auto loans have nearly doubled since early last year, and customers report feeling the effect of higher rates on affordability. On net, motor vehicle inflation has declined sharply because of the combined effects of these supply and demand factors. Similar dynamics are playing out for core goods inflation overall. As they do, the effects of monetary restraint should show through more fully over time. Core goods prices fell the last 2 months, but on a 12-month basis, core goods inflation remains well above its pre-pandemic level. Sustained progress is needed, and restrictive monetary policy is called for to achieve that progress. In the highly interest-sensitive housing sector, the effects of monetary policy became apparent soon after liftoff. Mortgage rates doubled over the course of 2022, causing housing starts and sales to fall and house price growth to plummet. Growth in market rents soon peaked and then steadily declined. Measured housing services inflation lagged these changes, as is typical, but has recently begun to fall. This inflation metric reflects rents paid by all tenants, as well as estimates of the equivalent rents that could be earned from homes that are owner-occupied. Because leases turn over slowly, it takes time for a decline in market rent growth to work its way into the overall inflation measure. The market rent slowdown has only recently begun to show through to that measure. The slowing growth in rents for new leases over roughly the past year can be thought of as in the pipeline and will affect measured housing services inflation over the coming year. Going forward, if market rent growth settles near pre-pandemic levels, housing services inflation should decline toward its pre-pandemic level as well, and we will continue to watch the market rent data closely for a signal of the upside and downside risks to housing services inflation. The final category, non-housing services, accounts for over half of the core PCE index and includes a broad range of services, such as healthcare, food services, transportation, and accommodations. 12-month inflation in this sector has moved sideways since liftoff. Inflation measured over the past 3 and 6 months has declined, however, which is encouraging. Part of the reason for the modest decline of non-housing services inflation so far is that many of these services were less affected by global supply chain bottlenecks and are generally thought to be less interest sensitive than other sectors, such as housing or durable goods. Production of these services is also relatively labor intensive, and the labor market remains tight. Given the size of this sector, some further progress here will be essential in restoring price stability. Over time, restrictive monetary policy will help bring aggregate supply and demand back into better balance, reducing inflationary pressures in this key sector. Turning then to the outlook, although further unwinding of pandemic-related distortions should continue to put some downward pressure on inflation, restrictive monetary policy will likely play an increasingly important role. Getting inflation sustainably back down to 2% is expected to require a period of below-trend economic growth, as well as some softening in labor market conditions. Restrictive monetary policy has tightened financial conditions, supporting the expectation of below-trend growth. Since last year's Symposium, the 2-year real yield is up about 250 basis points, and longer-term real yields are higher as well, by nearly 150 basis points. Beyond changes in interest rates, bank lending standards have tightened, and loan growth has slowed sharply. Such a tightening of broad financial conditions typically contributes to a slowing in the growth of economic activity, and there is evidence of that in this cycle as well. For example, growth in industrial production has slowed, and the amount spent on residential investment has declined in each of the past 5 quarters. But we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer-run trend. And recent readings on consumer spending have been especially robust. In addition, after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above-trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy. The rebalancing of the labor market has continued over the past year, but remains incomplete. Labor supply has improved, driven by stronger participation among workers aged 25 to 54, and by an increase in immigration back toward pre-pandemic levels. Indeed, the labor force participation rate of women in their prime working years reached an all-time high in June. Demand for labor has moderated as well. Job openings remain high but are trending lower. Payroll job growth has slowed significantly. Total hours worked has been flat over the past 6 months, and the average work week has declined to the lower end of its pre-pandemic range, reflecting a gradual normalization in labor market conditions. This rebalancing has eased wage pressures. Wage growth across a range of measures continues to slow, albeit gradually. While nominal wage growth must ultimately slow to a rate that is consistent with 2% inflation, what matters for households is real wage growth. Even as nominal wage growth has slowed, real wage growth has been increasing as inflation has fallen. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for a monetary policy response. Turning
All right,
to the
getting ready to sell.
2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. It is challenging, of course, to know in real time when such a stance has been achieved. There are some challenges that are common to all tightening cycles. For example, real interest rates are now positive and well above mainstream estimates of the neutral policy rate. We see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint. That assessment is further complicated by uncertainty about the duration of the lags with which monetary tightening affects economic activity and especially inflation. Since the symposium a year ago, the committee has raised the policy rate by 300 basis points, including 100 basis points over the past 7 months. And we have substantially reduced the size of our securities holdings. The wide range of estimates of these lags suggests that there may be significant further drag in the pipeline. Beyond these traditional sources of policy uncertainty, the supply and demand dislocations unique to this cycle raise further complications through their effects on inflation and labor market dynamics. For example, so far, job openings have declined substantially without increasing unemployment, a highly welcome but historically unusual result that appears to reflect large excess demand for labor. In addition, there is evidence that inflation has become more responsive to labor market tightness than was the case in recent decades.
Wow.
These changing dynamics may or may not persist, and this uncertainty underscores the need for agile policymaking. These uncertainties, both old and new, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. As is often the case, we are navigating by the stars under cloudy skies. In such circumstances, risk management considerations are critical. At upcoming meetings, we will assess our progress based on the totality of the data and the evolving outlook and risks. Based on this assessment, we will proceed carefully as we decide whether to tighten further or instead to hold the policy rate constant and await further data. Restoring price stability is essential to achieving both sides of our dual mandate. We will need price stability to achieve
watch for 3850, 3850
conditions that benefit all. And we will keep at it until the job is done. Thank you.
All right, he's done speaking. That dude's gonna speak longer than that. What the heck? Yeah, that sounds dovish. That's good for the market. But again, we all know based off of the previous 2 trading days, right? The market has been extremely choppy. So this is why you are seeing that I am choosing to reduce my position size at overbought levels. I am not sold on the idea.
There's nothing more powerful than you.
I'm not sold on the idea that the market has to continue to rally. Now, of course, in a perfect world, if I knew how to predict the future, yeah, it would be amazing, right? But just like you guys saw, the market sold off. I mean, you guys have to give me, a round of applause. You have to admit, for how I bought into this, right? Testing the moving average, how I added more to it. That was a textbook setup of a reversal. And let me give credit where it's due. My trades are never that ideal. And I'm not here to sugarcoat it for you like, oh, look how badass I am. No, I mean, that was a dope trade. That was a really good trade. It completely began to take off. I mean, I averaged up into it as you saw. I added to it incrementally, right? When direction became favorable, I added more to it. And then when we became overbought, I sold 2,000 shares all at once, right? Then I sold 500 and 500 again. So I'm very proud for how I performed there, but I know, right, and this is a perfect candle to represent how choppy today can be, right? It does not have to perform in one single way. Market can still continue to be choppy. Right now, we were up 3%. Imagine if the market closes in the red. Would that be the craziest thing that you would see? No. You know what I think is much crazier? Yesterday, where we gapped up, NVIDIA was up nearly 10% and it gave everything back. So if you think that it can't give back 2%, well, yesterday's move for TQQQ, right? Look how much that is. That's over a 10% move. So you can't think that it can't give back everything that it gained today. Obviously, there's a reason on why the market sold off, but based off of how Jerome Powell spoke and what he said, I don't think it was super hawkish. There was no remark that I heard. I don't know about you guys that surprised me. And this is something, right? I was just live with my LPP team literally right before this live stream. And I told him, I was like, hey, he kind of reads off of a script. It's very rare if he ever says anything that, surprises the market. But we'll see. We'll see if he does. And yeah, I mean, to me, there wasn't anything significant, but it doesn't matter what I think. It matters how the market digests that information. And as of right now, I still feel like it's indecisive, right? We had a nice little rip up. We had a nice rip down first, a nice rip up, and then now we're correcting ourselves. So we'll see if we go back to retest this moving average. And guess what? The only people that freak out when the market pulls on back are those that did not lock in profits and that did not prepare, right? So it had to be a positive mood, kind of, but then look at what's happening right now, right? We're correcting ourselves. And right before the meeting, NASDAQ was already up. I mean, TQQQ was up around to $38. So I'm not here to overcomplicate the trading today. I mean, it's very, very simple. Like, yes, you could have made money if you were a bull or if you were a bear, right? As long as you locked in profits, right? With this move, bears, this move bulls, this move bears. There's money to be made on both sides. Stop overcomplicating it. Stop making it personal. The stock market doesn't care about you. It doesn't care about me. We're irrelevant, right? Take your money and go. That's literally like how it is, right? It's like this isn't anything where you have to be emotional or you have to think that, oh, I want it, or I was hoping, or I think this. Who cares? It doesn't matter what you think, right? Stop overcomplicating your trading. Stop making it personal. It has nothing to do with you, and focus on just quality trades. Be effective. And if all of this choppiness doesn't meet your criteria, I respect that, because you respect yourself enough that you're not going to jump into something that doesn't meet your criteria. That's fair. That's the goal. If you can have enough criteria where you don't jump into something that is completely out of left field, then so be it. Be entitled. Be selective. There's nothing wrong with that in this market. The goal is to be the exact opposite of what AMC traders are, and that's bag holders and people who hope, right? This isn't a dream. This isn't something where you fingers crossed and I hope this happens, right? You have to be consistent. You have to understand what you're doing. You have to be effective with your entries and with your exits. So stop making it personal. Stop making it about you. It's not, right? You can have good days, you can have bad days, but at the end of it, it's all about the quality trades that you choose to take advantage of. Even when you take bad trades, we've said this before, you taking a red trade doesn't make you a bad trader. There's a lot of green trades that you can take that are still bad trades, right? It's all about how you got there. Not every trade you take is going to be green. Our job is not to avoid risk. Our job is to manage it. And you guys all know that, okay? We all have our own struggles, our own challenges of what we are trying to work on. Note them down, right? Why do you think that so many people talk about journaling their trades? Not to sugarcoat things, right? But it's to hold yourself accountable. And if you continue to make the same mistake over and over again and you do nothing to change it, I think that's the definition of insanity, right? All right. So, I mean, that's pretty much it. I only wanted to go live for that small period. I was just trading live with the LPP team. And again, I want to remind you, I mean, if you kind of like what you saw today where you were able to see my entries, normally I explain my thought process behind the trade, but Jerome Powell was obviously speaking and I don't want to offend people when I speak. So they would tell me to shut up. But normally every morning, if I do end up taking trades, right, I explain the thought process behind every trade. You get to see my good trades. You get to see my bad trades. You don't have to join my LPP team. But if you like what you saw today, that is exactly what they get to experience every single day. They are the only team that I work with on a daily basis. You don't have to join. But if you're tired of trying to figure this out all on your own and you feel like it would be of value for you to be able to wake up every morning and to tune on into a live session that's private just for our LPP team, you get to see my entries, exits, and my thought process, then that's going to be the second link in the description down below. It's a one-time payment, lifetime access, and we are running our biggest sale right now, and it's $175 off. So if you want to join, you can watch me trade live as soon as Monday. Okay, so it's all inclusive. I offer nothing else. It comes with the A to Z video lesson library and our private LPP group chat. So I really do appreciate your guys' time. It looks like now we are beginning to show signs of a potential support once again, or we're going to go back to retest the moving average, and let's see if we actually break below. Let's see if we break below this. Testing moving average. Is it going to do the same thing that it did last time? And are we going to bounce off of this, right? So this was a really nice rip for the bears. Right? Like we said, there's money to be made on both sides. So I don't know why people sometimes in the live, it's more people like when you're on YouTube or something, they try to go after one another because, oh, I'm bullish, I'm bearish. Dude, no one cares about your 500 shares you own of whatever company you have. You're irrelevant, right? It doesn't matter. Take your money, make your money, and leave, right? Stop thinking that, oh, I'm against you. Dude, if you could move markets, you'd have much, your opinion would matter much more. So focus on yourself. There's always money to be made on both sides. Someone else making money does not take away from your success. Stop taking it so personal, right? You guys are so rude to one another that it's counterproductive. Everyone's here for the same reason. We're all trying to make money. Let's embrace it, right? All right, testing support here. Let's see if we find the break above. If we end up breaking below the moving average, I'm going to have to manage my risk, and I will sell those 2,000 shares. before I close out the live stream, I want to see if we bounce or if we get rejected. All right. So I hope that it earned your thumbs up in this video. And hopefully you can consider subscribing. And if you have any questions, shoot me a direct message via Discord or via Instagram. There's so many of you guys that follow me, yet you never message me, yet you have so many questions. What the heck is that all about? Like, why not message me, right? Everything is linked in the description down below. I try to the best of my ability. I'm not perfect. I respond to all the messages I see. Sometimes I do overlook some, so just send me like a period so it pops right back up. I'm not trying to ignore you. But yeah, shoot me a DM, shoot me a message, and would love to be of value for you, right? If that's you being a part of LPP or you just being subscribed to the channel. Thank you, Gently. Appreciate that. And here it goes. Looks like it's about to break below. Waiting for a break below previous lows. And that's fine, right? Our job is not to be perfect. Our job is not to avoid risk. Our job is to manage it. Let's give it to 20. Went to lows of 23. What the heck are you doing, buddy? Follow at a distance, right? I don't have to overcomplicate it. This is why I'm sizing down on my position size. It's not anything too complicated. Here it goes. You guys see where my stop loss is at? It's at 37.19, right below that previous support. We'll see if we break below, right? It's testing potential support range here. Let's stay patient. Let's stay light, especially when direction is unclear. But look at this, right? If this thing does end up recovering, I can really step on the gas. These 2,000 shares are nothing. I can buy 15,000 shares, right? Really step on the gas when direction becomes favorable. But that's only when direction is actually favorable. I don't want to jump into something that really doesn't matter. And there it goes. Another 1,500 shares. Looks like we're beginning to bounce. I like that. Okay. Let's see. We're testing that moving average. We don't have to break above. But if we do, then we can really step on the gas. I'm going to leave the rest of the updates to our LPP team. So again, I'll keep you up to date if I end up adding more to my position size. Remember, second link in the description down below if you guys are ready to join our team. If not, no hard feelings. Again, feel free to send me a direct message if you have any questions before joining. I wish you guys nothing but the best. Continue working hard. Continue following your dreams. Let your passion be what drives your success. And like always, let's